Welcome to Breaking News to Trading Moves. You hear a corporate headline flash across your screen and, well, your immediate thought is probably, okay, what does this actually mean for the broader market?
Right, because it's rarely just about that one isolated event.
Exactly. So our goal for you today is to examine a specific headline and break down the explicit winners and losers across tech stocks.
Yeah, we really want to look directly at the business landscape to understand exactly how one company's performance, moves the needle for an entire ecosystem of suppliers, competitors, and component manufacturers.
Connect the dots, essentially.
That is the right framework. I mean, when we look at corporate earnings, especially from the largest entities in the market, it helps to view them as a diagnostic window into the broader economy.
Right.
We are not just looking at a standalone event here.
Definitely not.
Mm.
And the headline we're analyzing today gives us a very clear window. So here is the core focus. Apple shares are rising as the iPhone 17 and MacBook Neo drive a stronger forecast.
Okay, yeah.
But before we explore what this means for other companies,
Yeah.
let's lay out the initial data points from the report. First, Apple beat expectations on both sales and profit.
Which is a big deal right out of the gate.
Yeah, and Mac sales and services revenue also beat forecasts. Furthermore, China sales were stronger than expected.
Right, and that's a metric everyone in the financial world watches incredibly closely.
Oh, very closely. And finally, the company authorized a fresh $100 billion share buyback.
Wow. Yeah, when a company of that size reports those kinds of numbers, it provides a direct read on global tech hardware.
Right.
We're basically evaluating what consumer electronics demand, memory pricing, and chip supply currently look like out there.
Okay.
So for traders, this creates a really balanced setup to evaluate. I mean, the demand side looks robust, sure, but we also have to weigh the physical realities of the supply chain and corporate margins.
Yeah, that makes sense. I want to touch on those China numbers for a second, though, before we move into the broader ecosystem.
Yeah.
Why is that specific geographic metric always under a microscope?
Well, China represents a massive portion of the premium smartphone consumer base.
Right.
And recently, domestic competitors in that region have been aggressively trying to take market share. So Apple beating expectations there proves the resilience of their brand in a highly competitive geography.
Which is pretty crucial for them.
Exactly. If demand there holds up, the global volume forecast remains stable.
Okay, that makes perfect sense.
Mm-hmm.
Now let's talk about the hardware ecosystem.
Mm-hmm.
Strong demand naturally benefits the companies that help build those products, right?
Yeah, absolutely.
Because if the end consumer is buying, the builders stay busy.
Precisely. The healthy demand for premium devices, specifically, the iPhone 17 demand story, directly benefits the broader Apple ecosystem.
Right, the downstream players.
Yeah, suppliers, component makers, hardware partners, they all thrive when Apple unit volumes and upgrade cycles remain strong.
Because everyone needs to upgrade eventually.
Right. A strong upgrade cycle means millions of consumers are swapping out their old devices for new ones. And that translates to massive order volumes for every single internal part.
It's kind of like, think about building a modern skyscraper, right? The property developer gets their name on the building.
Sure.
But the company providing the structural steel and the company installing the elevators, I mean, they're the ones cashing massive recurring vendor checks.
That's a great way to look at it.
When the developer decides to build, the entire local construction economy goes into overdrive. So could you outline exactly which companies fall into this ecosystem benefit category, like the anchor tenant benefits?
Yeah, it's a highly interconnected group. The most direct winner is the anchor itself, Apple, ticker AAPL.
Right.
But let's look at the specialized vendors. You have Cirrus Logic, ticker CRUS. They are a primary supplier of audio components.
And audio isn't just a single speaker anymore, right? We're talking about spatial audio, multiple microphones, advanced noise cancellation.
Oh, absolutely.
There is a lot more silicon required just to manage sound nowadays.
Exactly. The complexity of the audio architecture has just exploded. So when Apple orders components for tens of millions of new phones, the volume of audio chips required from Cirrus Logic scales directly with that physical order.
Wow, okay. Who else?
Then you have Corning, ticker GLW. They're the manufacturer of the specialty glass used on the screens and the backs of the devices.
Which has also become more complex, I assume. Like you have ceramic shields, tougher, drop-resistant formulas.
Yeah, and specialized back glass to allow for magnetic wireless charging.
Right, right.
So their revenue is tied directly to the physical number of units rolling off the assembly line. The more complex the glass, well, the higher the value of the contract.
Okay, so more phones sold, means more specialty glass and more audio chips. But here is where we hit a bit of a contradiction in the
Okay, what
numbers.
do you mean?
Well, if demand is so strong, why did Apple warn that iPhone sales were actually held back? That points directly to the reality of the supply chain, right? I mean, if they have eager customers, why not just produce the phones faster?
Yeah, that is the supply chain bottleneck right there.
Mm-hmm.
iPhone sales are currently constrained by a lack of advanced processor chips.
Wait,
Yeah, Apple has the demand, but they cannot manufacture the devices fast enough because the most sophisticated silicon components are in short supply.
let me push back on that for a second, or at least ask for some clarification. Apple is one of the most cash-rich companies on Earth.
Yeah.
If they need more chips, couldn't they just, I don't know, pay a manufacturer to run the machines longer?
Uh-huh.
Or simply build another factory? We just mentioned they authorized a $100 billion share buyback.
Right.
Why not spend that money on a chip factory instead?
It's a logical question, but it just doesn't work like that in practice. The bottleneck is the physical manufacturing capacity for advanced nanometer nodes. We're talking about microscopic, leading-edge fabrication. There are only a very small number of facilities in the entire world capable of etching these specific high-efficiency processors.
So you can't just throw money at it.
No, you cannot just flip a switch to open a new facility. They cost tens of billions of dollars, they require incredibly specialized engineering talent, and they take years to build.
Wow.
Even with all the cash in the world, the physical manufacturing capacity we have today is finite. Returning capital to shareholders via a buyback is a more immediate use of cash when you literally cannot buy more factory capacity.
Okay, so if the factory capacity is finite, who is Apple fighting against for that time?
Mhm.
I mean, if a company with their buying power is struggling to get advanced chips, who else is taking up that space?
You are hitting on the exact bottleneck in the global technology sector right now.
Okay, what is it?
Advanced chip capacity remains tight across the whole market because artificial intelligence demand is competing for the exact same leading-edge semiconductor ecosystem.
Oh, wow. So AI is the culprit.
Exactly. The facilities that manufacture the microscopic, highly efficient chips for premium smartphones, those are the identical facilities tasked with manufacturing the processors that power AI data centers.
So the AI boom is actively competing in a bidding war with the smartphone market for the same physical manufacturing lines.
Yes, exactly.
That's wild.
Mhm.
Okay, let's categorize the winners here, starting with the AI chip and advanced semiconductor supply chain. The companies benefiting from this tight supply and high demand include NVIDIA, ticker NVDA,
Right.
Advanced Micro Devices, ticker AMD Broadcom, ticker AVGO, and Qualcomm, ticker QCOM.
Yeah. These companies design the advanced architecture that everyone is fighting over. Because factory capacity is tight and demand is relentless, these specific companies maintain supreme pricing power.
Makes sense.
And, that exact same dynamic applies to the physical memory inside these devices, too. Apple warned that memory costs will become a bigger pressure in the upcoming June quarter and beyond.
Let's talk about memory for a moment. Why are memory costs suddenly a pressure point? Did the industry just forget how to make storage chips?
No, it's a matter of supply and demand timing. Memory manufacturers actually cut their production levels previously to stabilize prices when there was an oversupply in the market.
Oh, right.
Now, demand has roared back, and it takes time to ramp production back up to full speed. Furthermore, AI requires something called high bandwidth memory, which is incredibly complex to build.
So that eats up the factory floor.
Exactly. Because memory makers are dedicating factory floor space to high bandwidth memory for AI data centers, they have less physical capacity available for regular smartphone and PC memory. Less supply equals higher prices.
Which means the sellers are commanding a premium.
Yes.
So the companies benefiting from higher memory pricing include Micron Technology, ticker MU, Western Digital, ticker WDC, and Seagate Technology, ticker STX.
Correct. They are currently the beneficiaries of this constrained environment.
But building on that point about rising memory costs, it reveals a clear divide. Because if higher memory prices are a definitive win for the chip makers, they must be a severe penalty for the companies buying those chips to build computers.
Right.
It's kind of a zero-sum game on the hardware side.
It is a direct hit to gross margins. These memory costs are a burden across the hardware space. I mean, even Apple, with its premium pricing power and massive services business to offset those costs, warned it would pressure their margins.
Wow.
But for companies that are strictly reliant on hardware sales without a software ecosystem to fall back on, well, the margin sensitivity is much more critical. They feel the pinch much more acutely.
I want to explore that margin sensitivity.
Mm.
Because if a laptop manufacturer sees their internal memory costs go up by 20%, why don't they just pass that cost on to the consumer? Like, why not just raise the retail price of the laptop by $50?
Well, it comes down to price elasticity and the specific business model of these hardware makers.
Mhm.
Companies that assemble traditional PCs often operate on incredibly thin profit margins to begin with.
Right.
They buy the processors, they buy the memory, they put it in a case, and they sell it. In the premium market, sure, a consumer might swallow a slight price increase, but in the entry-level or education markets, buyers are incredibly price sensitive.
Right. Like if a school district is buying 10,000 laptops, they have a strict fixed budget.
Exactly.
If the manufacturer raises the price per unit, that district will just look for a cheaper alternative.
Exactly. So the manufacturer often has to absorb the increased component cost, which absolutely crushes their profit margin.
Which brings us to the second part of our headline.
Yeah.
The lower-priced MacBook Neo. This adds another layer of pressure, right?
It really does.
Apple is stepping directly into that entry-level market, a space historically dominated by Google Chromebooks. Just to be clear, Chromebooks have owned the classroom for years because they're basically just a web browser and a plastic shell, right?
Right.
They rely on cloud computing rather than expensive internal hardware, keeping the cost low.
Yeah, that is the traditional model. But by introducing the MacBook Neo, Apple targets the education sector and entry-level corporate markets.
Okay.
They're attempting to offer a full desktop operating system experience at a price point that competes directly with those stripped-down cloud devices.
Oh, wow.
And by doing so, they apply intense pressure to traditional PC makers and the Chromebook ecosystem.
So these legacy hardware makers are getting squeezed from both sides simultaneously.
Yeah.
Component costs are rising from the bottom, making the devices more expensive to build, and a premium competitor is capping what they can charge at the top.
That's exactly it.
Let's list the losers facing this specific margin and competitive pressure. Starting with the margin-sensitive and high-cost hardware players, we're looking at HP, ticker HPQ, and Dell Technologies, ticker DELL.
Right.
And when we look at the low-cost laptop and Chromebook exposed names, the pressure falls on Alphabet, ticker GOOGL, alongside HP, ticker HPQ, and Dell Technologies, ticker DELL.
The hardware business is notoriously unforgiving. When you sit in the middle of rising supply chain costs and an aggressive new product launch from a competitor, your margins inevitably compress.
It really highlights how Apple is fighting on multiple fronts at the exact same time.
They really are.
They're defending the premium phone market, aggressively entering the lower-cost hardware space with the MacBook Neo, and now they're fighting the battle for AI credibility.
Yeah, and the AI strategy is a core focus for investors right now. I mean, Apple has faced ongoing scrutiny regarding its overall artificial intelligence strategy and how they plan to integrate generative features into their operating systems.
Right.
Because of this, Apple's research and development costs have risen sharply. The market is closely watching their ability to genuinely compete in the broader AI space.
When we talk about R&D costs rising for artificial intelligence, where is that money actually going? Are they just, hiring thousands of new software engineers?
Well, engineers are a large part of it, certainly, but a massive portion of that capital goes toward raw computing power.
Oh, the hardware again.
Yeah. Train a large language model requires running tens of thousands of advanced processors around the clock for months. The hardware procurement and the electricity bills alone are staggering. That is the physical barrier to entry in this specific sector.
Right. And when a company with Apple's cash reserves decides to ramp up R&D to enter a space, it forces other major tech companies to watch their own backs.
Absolutely.
It creates an arms race mentality. It's like a high-stakes poker game. If one player suddenly pushes a mountain of chips into the middle of the table, you either have to match that bet or fold. Nobody can just sit back and do nothing while a competitor outspends them.
That is the capital expenditure contest playing out right now. The established leaders in the AI space suddenly have a well-funded, consumer-facing competitor gearing up to challenge them.
Right.
This requires them to spend even more money to maintain their technological lead. That requirement to constantly accelerate spending can weigh heavily on their own profit margins and alter investor expectations for their future cash flows.
Let's list the big tech companies currently under AI pressure. due to this highly competitive landscape.
Mm-hmm.
We have Microsoft, ticker MSFT,
Yep.
Alphabet, ticker GOGL, and Meta Platforms, ticker META.
Right. All of these entities now have to factor a highly motivated Apple into their long-term strategic models. They have to continually justify their massive capital expenditures to their own shareholders.
It's all connected.
It is. And as we evaluate all these moving parts, there is a broader central question you have to consider. As consumer electronics demand remains healthy but supply constraints tighten, what happens to hardware margins when multiple trillion-dollar companies are all fighting over the exact same limited batch of advanced chips and memory components?
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.